Want new ideas of what to buy in FY26? In this series, we're sharing our best investment ideas for the new financial year. Today, we're looking at 4 individual stocks. Welcome to Get Started Investing, a podcast where we help you make the most of your money. My name's Bryce, and as always, I'm joined by my equity buddy, Ren. How are you going?
I'm very good, Bryce. Very excited for this episode. Enjoying this series where we're sharing some of our best ideas for the financial year ahead. Last episode, we chatted all things ETFs, so you can go and check that episode out wherever you're watching or listening to this. But in today's episode, we are talking individual stocks.
Yes, big time. Satellite portfolio. We've covered off the core enough, so it's time we get into some of the individual companies that are on our watch list or already part of our portfolio that we're excited for in FY26. Before we jump into that, though, a huge thank you goes to our long-term partner here at Get Started Investing, Beta Shares Direct.
Looking to invest your way, Beta Shares Direct makes it easy.
There's $0 brokerage on over 300 ASX shares and all ETFs. You can choose from 10 plus ready-made portfolios or build your own from scratch.
Automated investing means you can set, forget, and grow. And with simple tax and performance reporting, staying on top of your money has never been easier.
It's a platform unlike anything else here in Australia.
Search Beta Shares Direct and set up your account in minutes.
Beta Shares Capital Limited is the issuer. Consider the PDS and TMD at betashares.com.au to see if the product is right for you. Investing involves risk.
All right, 4 stocks, 2 each. Let's get into it. Why don't you lead us off?
Okay. This is a once-in-a-generation opportunity, Ren.
Oh, here we go. I'm glad that these episodes start with disclaimers.
Very much so.
Because about
very
what
much
you're
so.
about to say. But everyone remember, Bryce is not aware of your personal financial circumstances.
No. This is a company that is in my portfolio. I do own it. And throughout FY26, I will be buying this opportunistically as the price, as opportunities come. But the company is Eli Lilly. For those unaware, Eli Lilly is one of the leading pharmaceutical companies around the world. It is a leader in the GLP-1 drugs, Zepbound and Mounjaro, competing with Novo Nordisk's Ozempic. They also are very prominent in drug manufacturing for Alzheimer's, which I'll get to, among a whole raft of other drugs. But really the thesis for me is around the GLP-1 and the obesity drugs. Just to put some numbers to it, the obesity market is tipped to be worth $100 billion by 2030, so a huge addressable market with over 650 million adults worldwide clinically diagnosed as obese. And so their 2 drugs, Mounjaro and Zepbound, are very much in their infancy but are taking huge market share. And for me, Ren, long-term here is just the ability for these drugs to have mass adoption. We're seeing huge demand from patients, but I think also not only patients, doctors are also really starting to talk about the positive health effects of these drugs, not only for weight loss, but many other diseases. And Eli Lilly is positioned right smack bang in the middle of this trend. Early day trend, I should say. The pipeline for these drugs is pretty deep. They've got a new drug on the way called retatrutide. It is a little bit stronger than Mounjaro and Zepbound, and they're also looking at oral versions of these drugs because at the moment you need to inject it in sort of once a week. So I just think for me, I look where the world's kind of going. I look at the impact that obesity is having globally. I look at the size of the market and I look at where Eli Lilly is positioned. And I just think that long term, we have an opportunity to get in at its infancy.
And why Eli Lilly over Novo Nordisk?
At the moment, the drugs that Eli are creating are more effective. They have a stronger pipeline of drugs. They have greater R&D spend, but I think the company is also de-risked in a way with all of the other drugs in their pipelines. They are on the cusp of launching a drug that could become the standard therapy for Alzheimer's treatment, which is huge. It's in phase 3 trials.
A lot of pharmaceutical companies are on the cusp of doing a lot of things that never eventuate.
Very, very positive signs. You're right. It's not obviously it's in phase 3 trial. But if that can sort of come through, then I think having a base of other drugs is the de-risk here. But I think, yes, you're right. Ozempic was the leader, but Eli Lilly is certainly taking market share.
All right. Well, that's an interesting one. You've certainly spoken about it before. I'm sure you'll
very
speak about it
bullish.
again.
Very bullish.
A reminder that earlier this year, we launched a 4-step stock checklist that you can download if you want to see how we analyze companies and if you want to put, I guess, some of the companies you're owning through our checklist to see if they stack up. But let's move on. My turn. And I'm just going to start with a company I'm not buying, but it is my largest holding. And I enjoy talking about it. So I figured I would start with it. It's called Axon Enterprise. And the genesis of the company was trying to create non-lethal alternatives for police officers. And so they invented the taser. And that's kind of how they started. But that's not why I own them, and that's not where their future is. They are the leaders in police body cameras, and you'll notice it once you become a shareholder. You notice it. It's what I can't remember what that effect is called, where like someone says something, then you see it all the time. But when you watch shows now, like cop shows on Netflix or anything, like fictional shows as well, and whenever you see body camera footage, look in the top right corner. You'll see Axon.
Oh, really?
Yeah.
Even on fictional?
Yeah.
Oh,
it's
nice.
like they're like part of the culture now.
Yeah,
They're ingrained.
Yeah, right.
Every time I see it, I'm like, thesis tick. So police body cameras are a piece of hardware, but this is becoming more and more a software company, because then they have a whole raft of software platforms that the body camera footage gets uploaded to, but then also community members can also upload evidence to these platforms, and then those platforms are used to manage evidence through as the case moves through the justice system, from police to prosecutors to courts, and it becomes this incredibly sticky environment where the switching costs become nigh impossible. Like if you and I got together and built a better evidence management system and connected it to hardware that we built, body cameras, it would be so hard to get basically police departments around America and more around the world to switch. So that's essentially what the company does, and sort of like where its moat is. It has been a consistent grower. So over the past 10 years, from 2015 to 2024 inclusive, year-on-year revenue growth, the lowest it has been in any given year was 20.3%, and the highest it has been is 37.5%. It has just sat in that, between 20% and high 30% range every year on year, growing and growing and growing, which I love to see. We speak about the rule of 40 with software companies, and for people who are unfamiliar with that, it's when you're looking at a software as a service company, you want to see the revenue growth rate and the profit margin when added together equal more than 40. That's kind of like a rule of thumb of a software company that's doing well. In the past full year, 18% profit margin, 33% revenue growth. So still satisfies the rule of 40. So that's some of the reasons I like it. I said earlier, I'm not buying more. It is on the more expensive side now. I think part of the reason I love this so much is I found it pretty early, but more and more of the market are definitely waking up to it. I just saw in Munro Partners' recent investor release, they wrote it up, which was nice to see. But here's why I want to talk about it today and bring some new information to the table, because more and more they are emerging as a potential big AI winner.
True.
I think we're starting to see the AI story move from who's building the technology, then it went to the picks and shovels who are supplying the people that are building the technology. Now the third iteration of the AI story is which companies are going to best utilize the technology. Yeah. And Axon has some pretty cool examples. So the first one is called Draft One, and it now uses AI to analyze the police body camera footage that it's capturing to write the first draft of a police report.
Which we all know cops don't like paperwork.
Cops hate paperwork. Fort Collins Police Department over in the States, they were one of the pilots for this. They saved 67% of police officers' times in writing reports. And that means, more time for cops to be on the beat, more efficient use of resources. All of a sudden, that then justifies paying Axon more as they raise prices over time. But that's just the start of their AI product suite. So here's a few other examples of how they're integrating AI into their business. Axon Evidence now translates and transcribes body-worn camera footage. So it's not only writing the police reports, but, it's, I guess, summarizing interactions and if no longer needing translators. So that's been a win. Axon Fleet 3, which is how they can scan like license plates and cars and stuff like that, now can scan license plates across 3 lanes of traffic, moving up to 140 miles per hour, and automatically check all their databases for those license plates. So again, just making police officers' jobs easier and more efficient. Axon DFR is now their cameras have beyond line of sight capabilities. So their cameras with AI can now see and identify objects before the human eye can see it. And again, then like alert police if there's something going on or, something that they need to be aware of or anything like that. There's a bunch of other examples where they're integrating AI. But for me, it's just like there's this massive, they've rolled out all this hardware. They've now got the software platform as well, which makes it incredibly sticky. And now they're finding ways to integrate AI, expand their product offering, go and charge their customers more, but also make their customers more reliant on their product. They use that money to reinvest in R&D and they go again.
Nice. Love it.
So that's the spiel.
Solid company. Yeah. Very, very interesting in the smaller cap space at the moment, but seems to be growing pretty quickly. Nice. Well, 2 stocks to kick us off. We're going to take...
sorry, you said it's smaller cap. It's a $60 billion company.
Oh, it's $60 billion?
Yeah.
Shit.
It's big.
I thought it was smaller than that.
It's almost 10 bagged in the last 5 years.
Well, that's... Yeah, okay, there you go. Yeah. Solid. Yeah. Got 2 to close out. I'll start, as always.
Yeah, sure. Go for it.
Now, this company has been on my watch list this year. I don't actually own it, but I think this is a good example of of why boring can sometimes be good. The company is Verisign. The ticker is VRSN. It's listed over on the NASDAQ stock exchange. What it does, it runs the global database for .com and .net websites.
Yeah, right. Okay.
Which is nearly half of all websites in the world. I think they have about 160 billion website domain names under management.
So, and it's like if you buy a website through GoDaddy and then buying it from these guys, is that how it works?
Yeah.
Okay.
They charge, I think, about $10 US per domain. So it's not a lot. But
to be honest, I'm surprised that it's only half the websites in the world are .com or .net.
Yeah, me too. Think of how many there are .io,
Yeah, but half?
.com.au.
Well, .com.au still would be .com.
You would think so. .net, .gov. Shitloads of .gov. There's so many government websites.
All right.
So what they do is, I guess just to be specific, when someone types in google.com, Verisign then directs the lookup to the relevant server, which then points back to the exact IP address for google.com. So it's a pretty monopoly-driven... Well, it is a monopoly business because it's actually, back in the day, the US auctioned off the rights to own the contracts to do this.
Yeah, I was wondering where... Yeah.
So Verisign... I can't remember which business it was, but a business won those rights. Verisign... were also playing the game, acquired this business, and since 2000 have been acquiring a lot of other businesses in the space, and now are an absolute monopoly.
Right.
And own effectively the rights and responsibilities to manage most of, if not all of, the .com.net. What's great about it is it's one of those slow compounders. So the way it works is the contracts that the government approves allow for 7% price increases 4 out of every 6 years for .com registrations.
Okay.
And so if you look at the revenue for this business, we're not talking 10, 20, 30% revenue growth year on year. We're just talking very consistent revenue growth year after year in like low digits.
Yeah.
But what it is able to do is transfer, as the business grows, the operating costs don't need to grow with it. And so you see an increase in the margins of the business, and so increases in profitability. So over the last sort of 10 or 12 years, you've seen margins increase from 52% to 68%. And with that, what they've
gross margins.
gross margins,
Yeah.
operating margins.
No. Oh yeah.
And so what they've been able to do with, I guess that flows through to the profit line, is they've just been buying back stock at a rate of knots. They've reduced their share count by 40% in the last 10 years, and it's equated to an earnings per share annual growth of about 12.5% for the last 12 years.
Wow.
Yeah, so pretty interesting business. They don't have to do a lot. They just keep slowly. Some people talk of it as like the toll road business of the internet.
Yeah.
Like it's non-cyclical. If you think about it, it doesn't matter if there's macroeconomic factors or if there's recessions or whatever it is. Like websites need to keep operating. They do keep operating, and the cost that they're charging their customers versus running websites and building websites is very low. So it's predictable, it's highly profitable, and it's quietly just ticking away and is an integral part of how the internet works.
Wow.
So it's been on my watch list. It was mentioned by one of the experts earlier in the year, which is why I love Equity Mates. And yeah, I think it's just a good example of why boring can be good.
Nice. Well, Equity Mates, certainly not boring. Get started investing, certainly not boring. But yeah, no, I like that one. That's a interesting one.
So you've got one to close out, Ren?
Yeah. So this one, if Verisign is a boring, slow compounder, this one is the opposite of that.
Okay.
But, we're talking about new investment ideas for FY26. And for me, this one is potentially quite relevant in the coming year. The company is Coinbase.
Nice. Okay.
And so for me, for people unfamiliar, Coinbase is one of the world's largest cryptocurrency exchanges. Certainly one of the more, regulated and reputable cryptocurrency exchanges, I would say. Mm-hmm. And they have kind of taken that strength in the exchange market, like their customer numbers and their size, and they're pushing into adjacent services. And, they're almost becoming like an investment bank for cryptocurrency in some senses. They're doing a lot of custodial work. So, a lot of the cryptocurrency ETFs that now exist, Coinbase is the custodian for the crypto assets that are held by the ETF. So really, in a nutshell, Coinbase is becoming, the company behind a lot of the expansion in the crypto industry. Or as the industry expands, they're finding more and more ways to make money in the industry. Mm. So in the short term, the reason that I'm adding this to the conversation today is crypto recently hit an all-time high, crossed 110,000 for the first time ever, $110,000 for the first time ever. Feels like there's a bit of momentum there. We know at some point crypto will crash 80%. Like, guarantee that, lock it in, just like it's done in previous market cycles, 2017, 2021. We know at some point there will be an 80% crash. But for me, it feels like there might be another run before that crash. And so Coinbase is a way to in some ways it's a leveraged play on crypto, but also hopefully it's some downside protection, because even when crypto falls 80%, it's not like Coinbase will still be making money in different parts of the ecosystem. They'll still be custodians for...
Well, they'll still be making money on people panic selling.
They will, but also the ETFs will still exist. They'll still be the custodian. They'll still be making fees there. They'll still be doing other things as well. And so I had a look at their numbers to kind of understand that thesis a little more. So their revenue and profit is incredibly volatile. Mm. So they follow the Bitcoin price cycle, unsurprisingly. So in 2021, they made $7.3 billion in profit. And they've never got back to that mark again. 2021 being the peak of the last boom. Then they fell to 3.1 billion in 2022, then down again to 2.9 billion in 2023. As crypto recovers, so does their revenue, up to 6.3 billion in 2024. But the thing that I liked to see, the thing that gave me a bit of confidence, was in 2023, when their revenue was at its lowest ebb, they were still profitable. They made $95 million in profit in 2023.
That makes sense. There was a year from memory where they lost a fair chunk of cash.
Yeah. 2022. But I think if we think about the market at that time, 2021 was a year where it was like invest for growth. Money was cheap, go. And then a lot of unprofitable growth companies then had
Re-ratings.
that reckoning in
Yeah.
2022.
Yeah.
And the good companies got profitable quickly.
Yeah.
And so I think, we saw companies like Spotify focus on profitability, and we've really seen them hit an inflection point. Coinbase is one where there's like a level of responsibility that I was going to say is uncommon in the crypto industry, but that's unfair on the crypto industry. They were a company that got profitable.
Yeah.
And so I'm not sure what Coinbase will be in 20 or 30 years. But for me, it's like if you're thinking about ways to play this current cycle, it's one way to play it.
Nice. Well, I'm certainly going to talk about crypto in the next episode.
Okay.
So I also have a few questions for you around that, but you're going to have to wait till the next episode to find out. But that brings us to the end of today's episode, where we're sharing new ideas for FY26 that are on our watch list or that we're excited about. A reminder that if you have some ideas that you'd like to share with the community, we would love to hear from you. Leave us a voicemail, write to us, however you want to get in contact. equitymates.com/contact. Is probably the best way to do it, and we'll share your ideas on next week's episode.
Well, make sure you're subscribed wherever you're watching or listening so you don't miss next week's episode, where we unpack alternative assets that we're excited by in FY26 in the coming financial year. But until then, Bryce, I'll see you next time.
See ya.